everybody. Thanks for joining us today. We are giving a presentation from the Bonding Curve Research Group on a narrative model of a bonding curve demo that we've been creating for the inverter primary issuance market to demonstrate some of the qualitative functions of the curve. Just to note, this is a narrative model. Our next steps are to build a comprehensive CAD/CAD model for further computational analysis, but at the moment, this is a model to demonstrate some of the features and operation of the inverter primary issuance market. So to start with a couple of definitions, we have something like supply. Supply is the number of tokens in existence. This can be static or dynamic. In a primary issuance market, this would be a dynamic parameter, so your supply can change over time. The reserve is the amount of reserve assets that are deposited backing those tokens. So when you mint or burn on the bonding curve, you are depositing or removing reserve assets to increase or decrease the supply. The reserve ratio is the ratio of dollar reserves to, or asset reserves in whatever form, to tokens in supply. We also have mint fees and burn fees. This is the fee that is charged on the creation or redemption of tokens on the bonding curve. And this fee is accumulated into a treasury that can be spent according to discretionary policies. A quick recap of the bonding curve. This is a stock and flow diagram of the different assets that move through the bonding curve. So you can see when assets are deposited, there's a mint fee. This creates a supply of tokens and deposits the reserves in a smart contract. This is constant through the bonding curve invariant function. And when those reserves, or when the supply tokens are burnt or redeemed, the reserve collateral can be reclaimed, obviously with a burn fee. We can see the invariant equation for the bonding curve here. This is a graph of reserve versus supply, and the invariant V naught is equivalent to supply to the kappa over reserve. Kappa is a parameter that determines the shape of the curve, and it's also equivalent to 1 over the reserve ratio in a lot of cases. Just to run through some of the outcomes that we observed in the narrative model. The point of the narrative model, of course, is to understand the dynamics of the primary issuance market. This is not a quantitative model. None of the numbers here should be taken seriously. This is just basically to demonstrate some of the system behavior under different conditions. So you can see we have different parameters that we set here. Buy and sell pressure, we can simulate a bear market or a bull market with this slider. The mint fee and burn fee we can change here. You can see the separation between the primary market price is the yellow line in the middle, the mint price on the top, and the burn price on the bottom. When those change, of course, the gap widens or shrinks. The reserve ratio can also be set. So this sets the initial supply to reserve for the bonding curve, which can then tell us, how many initial reserves are required, what is the initial supply, how many simulation steps are we running this for, and then we can get an output that shows the blue line is the secondary market. The green and red lines sort of provide this range-bound stability. It's been called in different ecosystems, and we're also calculating the amount of fees that come through burning, minting, and of course arbitrage fees, because whenever the curve is arbitraged, there's an opportunity for money to be made in rebalancing. So this model was built to explore some of the parameters such as reserve ratio and mint and burn fees and how they impact these primary issuance markets over the lifetime of the system. And I'm going to turn it over to Rohan Mehta, who is the lead data scientist at Inverter, and to talk through some of these scenarios that we built in the narrative model.
Yeah, thanks, Jeff. So here we can actually look into a particular scenario that we've set up, where you have the buy and sell pressure at a negative 0.04, which again, the number doesn't matter, but what it means is there's a heavy sell pressure that is pushed onto the secondary market. And you can see that through the blue line in the first graph going down over time. Here we have a reserve ratio of 0.2. So it's on the lower end of what we can set in this model. And you can see that in case there wasn't this reserve ratio, the blue line itself would have actually completely collapsed. But here you can see that there's the red line, which is the burn price, is kind of almost bowing the price to within the range. It keeps like pushing it up. There's a consistent buy pressure that you can see the arbot creating through the arbitrage between the primary market and the secondary market, which pushes the primary market down, but it keeps the secondary market price from dropping completely. But in the same exact scenario, when we actually increase the reserve ratio to high, let's say to 0.96, as you can see here, what you end up seeing is the primary market price actually pretty much stays stable throughout. And under the same exact conditions of the same exact buy or sell pressure, you're seeing the secondary market being able to play within these ranges and not completely collapsing or like collapsing slowly over time as we see. The other scenario that we can actually play around with would be like with fees. And here you can see that when we increase the fees, you see a higher range between the primary and this between the primary market and the two lines, the green and the red ones, which are the burn price and the mint price. So you see the secondary market can play between those, reducing the amount of chances we have for arbitrage for the same exact movement of the secondary market. While if we lower the fees in the next case, you'll be able to see that you're actually uh, kind of narrowing the space in which the secondary market can play. And every time it hits one of the boundaries, you end up like the arbot steps in, collects fees, it collects its own profits, and you end up seeing this almost like more. We are kind of interfering with the secondary market more frequently. This increases the arbot profits, but it changes the supply and reserve more often. So it's a balancing act that we need to find between all these scenarios and the parameters that we have. Maybe we can look through the simulation itself. Yeah, Jeff.
Yeah, definitely. So this is the app that's built so far. As you saw, some of the scenarios, we played with a little bit of the buy or sell pressure. We evaluated, high fees, low fees, the trade-offs that are implied in different fee amounts, also the reserve ratios. And you can see as I change this, the required reserve as well as the invariant are changing here. So there's a number of parameters we can play with. We can also add different numbers of simulation steps. And when we hit play, this will run for 1,000 simulated steps. We're feeding in a randomized secondary market signal, and we're watching how the primary market responds to that. So you can see that any time that the secondary market tries to push above the mint price, there's an arbitrage opportunity, which gains arbitrage profits and some mint fees and burn fees. You can see the opposite if we go towards sell pressure. Also note the difference between the mint price and the burn price here, that we can have customized fees on either side. We can also see how the curve responds under a bear market conditions. The interesting thing, as Rohan pointed out, that the burn price acts as almost like a parachute. It prevents this this free fall in price that can happen on centralized limit order books. If there is clearing all of the buy orders, then the price is in free fall. This is what the primary issuance market can help to mitigate. There's always this buy pressure or sell pressure from the arbitrage bot, which can be an intelligent agent basically acting within the best interest of system health, creating these arbitrage opportunities, collecting the mint and burn fees and pushing those into a discretionary treasury, which can be used for additional support of the token economy or rewards for token economy users, and so on. So we can play with a bunch of these different parameters and understand how these systems evolve over time. Of course, just a reminder, this is just a narrative model. These numbers are not to be taken as quantitative. We'll need to do much more rigorous modeling using CAD and different forms of computational analysis to be able to access sort of deeper insights into how these curves operate quantitatively. Yeah, so this is the current model that we have so far. I'm looking forward to more features and more development to be built into this. But ultimately, our goals with this are to understand the volatility damping effects of a primary issuance market, to understand the fees that can be aggregated through mint fees, burn fees, and arbitrage, and also to create more adaptive and dynamic token ecosystems that can respond to demand in their ecosystem by increasing token supply. Of course, not without limit, but with reserves backing those tokens. We feel this can be a much more robust and dynamic ecosystem for tokens to live in the future. So we have a number of next steps on these models, particularly on the narrative model front. We want to start plugging in historical data of different ecosystems and understanding how they operate, and also creating an open interactive dashboard that people can play with these parameters and understand how these systems work. We'll also be moving forward with a CAD-CAD model to do more computational analysis, and looking at further arbitrage bot intelligent agent strategies to create different damping coefficients, if we can consider it that way, of price volatility damping and fee generation. So really interesting research to come in terms of trading, exploring these trade-offs between different parameters and understanding how primary issuance markets can solve a lot of the issues of fiat tokens in the crypto and Web3 space today. Thanks very much. Looking forward to chatting again in the future.